What's going on YouTube? In this video I'm going to compare what's better, stocks or real estate. Let's get into it. Okay, so we're going to start with stocks. Now, if you look at the S&P 500 over the last 90 years, the average return has been 9.5%. Now let's go into some of the pros of stocks. First pro, you do not need a big amount of capital to invest in stocks. There's even a new platform called Acorn where you can start investing your loose change when you buy things at the mall. So you might pay $13.10. The 90 cents will go into your Acorn investment account. But normally $1,000 is a good amount to start investing in stocks versus real estate where you might need $50,000 to $100,000 to start. The second pro is it's liquid. If, for example, all of a sudden an emergency came up and you needed some funds, you could sell your stocks and pretty much have the money in your account that day. The third investment is it's more passive. Now some people say real estate is passive income, and yeah, it kind of is, but there is a lot more you have to do. You have to go and inspect properties. You have to do building and pest inspections. You have to recruit agents. You need an accountant. You need a broker. There's lots you need to do for when you're doing your real estate deal. Where if you're just buying a stock or you're just buying an ETF, all you do, you go onto the website, I want 10 of these, boom, purchase, done. You can do it all in a click of a finger. It's a lot easier. Another pro, diversification. So what you can do is you can invest in an exchange traded fund, which pretty much just buys up a bunch of companies and has it in one fund. You can have 3,000 companies in an exchange traded fund, so your money's diversified across 3,000 companies. So if one company goes down, it may only be 1% of your portfolio, so it's not really a big deal. Versus if you've got $50,000, $100,000 in investing in investment property, say for example if the crime goes up through the roof in that area, if there's some kind of disaster, or if the tenants trash the building and you got to do all repairs and you're not getting any rental income, well then all your eggs are in that one real estate, at least for your first real estate deal anyways. Now let's go into the cons of stocks. So I guess the first thing is you can't leverage it as much as real estate, where real estate, you could leverage it up to 90% in some cases, but what I wouldn't recommend. Also, it is more liquid, which means it is more volatile. So you may come to retire and you just get bad luck, and when you retire, there's a stock market crash and it crashes 40%. So that's another con. But in saying that, that is a possibility for real estate. In where I live in Australia, I think in Darwin, property prices are down 25% from their peak. In Sydney, they're down 13%, and they're dropping at the moment pretty rapidly. So it can happen a bit in real estate, but it's more common to happen in stocks. Alright, now let's go into real estate. So the pros of real estate. Probably the biggest pro for real estate is leverage. You can buy a property and control an asset, that's worth $300,000 with only $60,000 of your own money. So if that property goes up 5%, you've just made $15,000. So that's a 5% return on $300,000. But 15% on $60,000 is roughly, quick calculation, 20-25% return, which is very hard to get in stocks where the average return is around 9%. But saying that again, leverage can sometimes be a double-edged sword. If you, I know some people in Australia, they'll get investment properties with 5% down, and like I said, in Sydney, the prices are down 13%, and in Darwin, from peak to trough, they're down around 25%. So that's where leverage can hurt you. And actually in Australia, you can't just hand their keys back. If you buy investment property and you sell it and you still got there's more debt than the property's worth, you've got to pay that. Another positive is the tenant pays off the debt for you. So, you know, they're paying the mortgage, and even if you're not, getting positive cash flow, they're actually paying down those down payments, so it is money in your pocket. Another pro is it's tangible. You can see it, you can touch it, you can smell it. Another pro is people are always going to need a place to live. Businesses are always going to need offices. Around where I live, they're not making any more land, so it has that supply and demand factor. And you have more control over your investment. So when you invest, say for example in Apple, if the management turns out really bad and runs a company down, you have no control over that. Well, say for example you buy a distressed property, and you've got some kind of trade background in construction, plumbing, electrician, you can actually go into that property and do cosmetic renovations to increase the value of the property and then get higher returns. Another thing with properties, you can do development. You can buy, for example, an old run-down house on a big block, and if you know what you're doing, you can smash down the old house and build 3 units. I know during the property boom in Melbourne, people made a lot of money doing that. Okay, so now we'll get into the cons. The cons, like I said, leverage. If the property value drops more than your deposit, well then, you're in negative equity. And in Australia, you still got to pay that back. Another con is it's less passive. So you've got to deal with recruiting agents. You got to do all your tax. Well, that's another pro actually. Is you can claim a lot of deduction. You can claim interest on the property. You can claim depreciation. So there's a lot of tax advantages. But yeah, the cons is it's less passive. There's a lot more to deal with, a lot more due diligence you need to do. So guys, I hope you liked the video on stocks versus real estate. You could probably argue all day what's better and what's not, but at the end of the day, don't ever invest in what you don't understand. So if you understand real estate and someone says you've got to get in shares and this company's gone to 10x, don't invest what you don't understand. If you understand the stock market but you don't understand real estate, and someone says it's this really good real estate deal, where you can make 50% return, don't invest in real estate. First, understand what you're investing, and 2, it's for different scenarios. For example, if you've only got $1,000, you can't invest in real estate, but you don't want to keep your money in a bank account where you're only getting a 2% interest rate. So what you can start out doing is you can start out investing in stocks, and then maybe once you build up 50 to 100k, then you could start thinking of, hey, do I want to get into real estate? But make sure you're getting a good deal and don't rush into it. Know what you're doing. But real estate and shares have been 2 of the biggest wealth creations for the average Joe's trying to get ahead. So I think if whatever path you go down, you're definitely going to be doing a lot better than if you did nothing and just like the average Joe, just spending all their income and getting into debt. So I hope you like this video, guys. Please like and subscribe. I've got a new camera now. I brought a mic. I got a tripod. I'm going all out. Things are getting pretty serious. So I'll see you in the next video.